An audit follows three phases: preliminary analytical procedure, substantive analytical procedure, and final analytical procedure. In this video, we will go through the preliminary analytical procedure, where the auditor mainly plans for the audit procedures. An auditor can perform several tasks to plan for his audit. Here are some of the tasks an auditor could perform to plan for the audit. We have gone through how materiality is determined in the previous video. Most auditors take 10% of the normalized net profit before tax as the materiality threshold. I will go through the remaining audit planning works. When it comes to comparative analysis, the auditor will calculate the absolute and percentage change in the various balance sheet and income statement account balance between the current financial year and the previous financial year. Financial ratios are mathematical comparison of financial statement accounts or categories. Sometimes the numbers in the financial statements are way too big such that it's hard to truly appreciate or identify relationships between one account and another. Therefore, financial ratio will help put the number into simpler terms so that we can perceive it at an easier manner and understand the relationship better. There are many types of financial ratios as you can see, but some of the more important ones include the receivable turnover ratio, average inventory period, average payment period, days sales in inventory, days sales outstanding, debt to equity ratio, gross margin ratio, inventory turnover ratio, net profit margin, payables turnover ratio, quick ratio, and the times interest earned ratio. You may want to visit this website and click on the respective links to learn more about this financial ratio and what they tell about the company. When it comes to developing an auditor's expectation of the financial statement figures, the auditor will analyze the plausible relationship among financial and non-financial data to roughly estimate what the figures could be. This figure is just an estimation, but what's more important is that the auditor used reasonable basis to compute its expected figures. Often, there is no right nor wrong answer for this. Let me give you an example. Let's assume the current year's sales figure is 1,245,000. Previous year's sales, 1 million. Previous year cost of sales, 500,000. There is no changes in the price of raw materials. Develop an auditor's expectation for the current year cost of sales figure. We noted that sales has increased by 24.5%. Given that the price of raw materials remain the same, we expect cost of sales to increase in tandem with the increase in sales volume. So the auditor's expectation will be 124.5% multiplied by the previous year cost of sales figure, giving us $622,500. So this is the auditor's estimation of the current year cost of sales figure. The auditor can then compare the estimated figure with the unaudited figures. As mentioned in the previous video, an auditor does not have the time to ensure all numbers in the financial statements are accurate to the dollars and cents. Therefore, the auditor should focus more of their time on accounts with a higher risk of material misstatements. Here are a few ways to identify accounts with a higher risk of material misstatement. Based on the comparative analysis, the auditor may notice a substantial change in the account numbers for the current year compared to the previous year. Whether a change is deemed substantive is a question of judgment. Another sign that an account is likely to be materially misstated is if the auditor's estimation of the figure is significantly different from the unaudited figures. Again, whether the figures are significantly different is a judgment call. Most auditors, however, regard a difference greater than 5% as a significant difference. After identifying accounts with a higher risk of material misstatements, the auditor can consider possible misstatements in the account. One of the auditor's responsibility is to assess the validity of the going concern accounting. Hence, an auditor should assess the risk of financial failure. Financial ratio analysis could portray the numbers in an easy-to-perceive manner and highlight any signs of financial failure easily.
Assessing the risk of financial failure is a judgment call, but generally, an auditor should be concerned if he observes the following.